As you transition into retirement, you go from stuffing away as much money as you possibly can to now depending on those savings to pay for a good chunk of your living expenses. So needless to say, investing becomes a bit more nuanced during your retirement years. In this video, I'll share the steps that I take with my pre-retiree clients to help them to construct a portfolio that aligns with their personal situation and their financial goals. My name is Michael Carbone. I'm a financial planner and a money manager in Greater Boston, and I'm here to teach you how to stack the deck and put the odds of long-term financial success in your favor. So there are 4 broad steps to constructing an investment portfolio for a pre-retiree investor. So the first step is to gather information about their financial resources. The second step is to analyze their future spending needs. The third step is to determine the appropriate allocation, the appropriate target allocation, and then finally to choose the specific investments that they'll invest in. So during the phase of gathering financial information, the more relevant information that I'll look to figure out is what their assets are. And so when you're looking at assets, you want to know what types of accounts their money is held in, the underlying investments that they have in each account, and the broad asset class that those specific investments would fall under, and then any cost basis information or tax basis information for investments that are held outside of retirement accounts and just normal taxable non-qualified accounts. It's also really important to have detailed information regarding your current and your future income and the amount that you're saving. And so this would involve your wages, your any Social Security that you're expected to have, or pensions, as well as the amount that you're putting into 401k accounts or an amount that your savings accounts at the bank are annually rising by in a permanent way. And you might be wondering why this is relevant or important to constructing an investment portfolio, but I can tell you that it is extremely important. And if you really think about it intuitively, the amount that you have that you're receiving in income and the amount that you're not spending that's going into 401ks and going to the bank, after you pay those taxes on that money, you can really start to gain an understanding of what you are spending today. And by knowing what you're spending today, you can, gain a pretty solid understanding of what you'll be spending in the future. And what you're spending in the future will ultimately, tell you how much income you need to produce from your assets, and how much income that you need to produce from your assets will give us a good idea of how much risk that you need to take in your portfolio. So let's take a look at a hypothetical couple, spouse 1 and spouse 2. And before I do so, I want to be clear that it really doesn't matter if these numbers are off or, by a large amount even from your own situation. The numbers don't matter. It's the concepts that matter. And it's the concepts that you want to be thinking about and paying attention to. These concepts can really be applied to anybody that's investing their money towards a future goal. So spouse 1 and 2 are the ages of 64 and 62 respectively, and they'll be retiring in the next 3 and 5 years. They have a total of $275,000 between the two of them in working years income from their wages, and they'll have $93,000 in retirement income from Social Security and pensions. Each income stream will be beginning at a different year. For investment assets, they have roughly $1.5 million in total. And this doesn't include their primary residence, which we'll be ignoring in this case because they do want to assure that they'll never have to use this asset for living expenses in retirement. So it wouldn't necessarily be relevant for how they're investing their money. Of those $1.5 million in investment assets, the accounts are split equally between non-retirement and retirement accounts. They have a number of different types of investments that total to an overall allocation of 85% in stock and 15% in bonds. And we'll take a deeper look at this at a later point in the video. Okay, so now that we have an understanding of their financial resources that they'll have available to them, the second step is to analyze their retirement spending needs. And there are a number of different ways that you can do this, but for this couple, they don't expect their retirement spending to change much beyond the fact that they will no longer be saving in their retirement accounts. So with that in mind, to estimate their future expected spending needs in retirement, we're going to take a look at their income and what they've been saving and paying in taxes to gain an understanding of what their cash flow is, and then back into our own estimate. So the intuition behind this process is that your cash flow is your cash flow. So if you understand how much cash that you have available to you to spend after receiving your income and saving in retirement accounts and then paying taxes on that income, you can then back into how much cash you've been spending. And then from there, you can project out how much cash you'll need for spending in the future. So let's start from the top. So spouse 1, their wages are around $125,000. Spouse 2, their typical wages are around $150,000. So their taxable income that they're receiving from dividends and interest from the securities that they hold outside of retirement accounts is around $40,000. And if you'll note here, it says that none of this income is being reinvested. So it is available to them to spend. Spouse one is saving $30,000 in a 401k. That's before taxes. They're not spending that income. Spouse two, same thing, was $8,000. They're not spending that income. The total taxes that they're paying on their income and their capital gains and every tax that they're paying on their income that's available to them to spend is around $80,534. So that leaves them with a cash amount available to spend each year of $196,000. So from there, we can make adjustments, right, based on reality and what's been happening. So the cash that they've had available to spend, again, is $196,000. They've been saving. They're in their savings accounts at the bank where their checks are getting deposited into. Those are rising by $30,000 a year annually, right? So after taxes come out of their income, they have money that's getting deposited into their savings accounts at the bank, and that money is permanently rising by $30,000 a year. They're not spending that money. And then so finally, we'll make an adjustment here for intermittent costs. And I've said this in other videos, but there are costs that are invisible to a normal budget. And that would be things like home improvement and upkeep. If you need to replace the roof in 20 years, you're not going to put it in your budget, but at some point in the future, you're going to need cash to use to spend and pay for those intermittent costs. And so what we're doing is we're essentially just making a buffer here for those average costs that wouldn't be normally captured in your budget. So we have $196,000 minus $30,000 because you weren't spending that, and then from there we're adding an additional $10,000 for a total living expenditure spending assumption of $176,466. All right, so let's move on to the third step, which is determining the appropriate target allocation between stocks and bonds or growth-oriented investments and income and preservation-oriented investments. So if you remember from the when we were going over their financial resources, this couple's current allocation is split roughly 85% in growth stuff like stocks and 15% in more income and preservation-oriented stuff like bonds and money markets. So keep this in mind as we go through the next step. So the foundation to portfolio construction for any non-institutional investor is to find the optimal allocation as measured by the mix between stocks and bonds and other types of investments that offer enough growth to meet the investor's long-term goals with the least amount of risk. So let's take a deeper look at what that means. So your need to accept risk is another way of describing the rate of return that you need to grow your money by in order to meet or pay for your future spending needs. And then your capacity for accepting risk is another way of describing how much downside volatility that you can tolerate or afford to take. And there are two subcomponents that determine your capacity for risk. And the first is your need for cash or liquidity to meet your spending needs in the near future, and then your personal willingness to experience fluctuations in the value of your money. Although we said earlier that the goal in constructing a portfolio is to find that optimal mix between your needs and your capacity for risk, you should always prioritize the latter, as the consequences of overestimating your capacity for risk are likely far worse than the potential opportunity costs of taking on too little risk. So in summary, the foundation for constructing an investment portfolio is to find the optimal mix of investments that offers potential investment returns to support your future spending needs while also ensuring that your short-term spending needs are met and you have a smooth ride psychologically without any great anxiety about any swings in your portfolio. All right, so let's build from that and start to think about how we can determine the investor's growth needs. And remember, what we're trying to do is solve for how much the investor needs to grow their money by, because at the end of the day, different types of investments offer different growth potential. And so if we know how much they need to grow their money by, we can use it as one of the major considerations for how much risk they should be taking in their portfolio. And so the way that we do this is we try and solve for a minimum required investment return. And so that's just a fancy way of saying what is the lowest return that this investor can possibly earn on their money if they are to pay for all of their future spending needs. And so it can become complicated depending on the situation. Say, for example, the investor wishes to leave a certain amount of money to a charity in 20 years, right? That would be something they need to consider when they're calculating that minimum required return. For simplicity and just to ensure that I can explain this concept effectively, I'm just going to assume that this hypothetical couple simply wishes to maintain their lifestyle for a longer than average life expectancy. All right, so let's revisit our hypothetical pre-retiree couple. And if you remember, this couple plans to retire in the next 3 and 5 years. So as their wages fall off, they're going to need to start spending money from their investment portfolio. So what we're trying to solve for is how much income or how much cash that they're going to need from their portfolio, using that cash need to solve for the lowest return that they'd have to earn with their base of money that they have and still meet those needs. And then finally, take that minimum required return and solve for the optimal target allocation that's most likely to earn that return. So what you're looking at in your screen is a cash flow model that's taking all of the income that's coming through this couple's household and then subtracting all of the money that's needed to pay for taxes and living expenditures. That leaves them with either a surplus or a deficit. If it's a surplus, which it will be during their working years, if you remember they were saving in their bank accounts by 30 grand a year. If it's a surplus, the next year that will be added back into their assets. And then alternatively, if there is a deficit, which will occur when they retire, that money will be spent from their portfolio. And so that's what we're ultimately investing for in the first place, is to ensure that they can meet that deficit and meet those cash needs for the rest of their lives or whatever their goals may be. So just to give you some background on how this model works, as we go down, the couple is getting older. So as you can see, spouse one retires in 3 years, spouse two retires in 5 years. So they have, 333 grand in total coming in through the household from inflows, including investment portfolio returns. Then they pay all their taxes, and they have 302,000 in outflows. So their inflows are greater than their outflows until the first spouse retires. Their cash flow goes slightly negative once the first spouse retires, and then finally the second spouse retires in year 6. Their cash flow goes negative significantly. In these few years, they don't have their full income from Social Security because the first spouse is waiting until the age of 70 to take Social Security. So their cash flow improves a bit. They need a little bit less. There's a little less stress being put on their assets once they start receiving their full retirement income. But in anything that's red, they still are needing to pull from their portfolio. And given their base of money, if they have $1.5 million, if they simply just subtracted all this money without growing their money, it would run out really fast. And so what we're trying to determine is what is the lowest return that they'd have to earn such that their money wouldn't run out. And so I said earlier that their goal, or the example that we're going to use, is that their goal is simply to maintain their lifestyle for a longer than average life expectancy. So I have highlighted here the average age of 95, which is slightly longer than the average life expectancy. So what we want to see is their assets, which is this yellow column. We want their assets to be approaching zero towards this average age of 95. All right. And so we're going to make some assumptions here. So right now they have an allocation of 85% in stocks and 15% in bonds. So they're 85-15 stock to bond, 85-15 growth to income and preservation. And so then we have to make assumptions for what stocks might earn over the long run. And so this is this is sort of an art as well as a science. But the way that I like to look at it is, if we're looking forward to the future, we should be slightly conservative and not assume that stocks will be, above average for a very long period of time, because stocks tend to revert to their long-term mean average. The last decade and a half, we've had very positive, strong market returns that have been above the average, and that simply just implies that valuations are a bit rich and that we may have, slightly lower than average future stock returns. And so I'm assuming 8.5% for stocks. That's slightly lower than the long-term historical average for stocks, including dividends. But I do feel more comfortable in doing so, just to ensure that we're, eliminating any error in our forecasting, our projections. And then so for bond returns, we're assuming 3.5%. Bonds typically tend to grow by a slight premium to inflation, which we're assuming is around 2.75%. So their expenditures are growing by 2.75%. We're assuming that bond returns over the long run are around 3.5%, slightly higher than the rate of inflation. So based on that portfolio, 85-15 stock to bond, and then using those return assumptions, that ends up being a portfolio return of around 7.8%, right? So we're taking 85%, multiplying that by the stock return, and then 15% multiplying that by the bond return, and then combining it for a portfolio return of around 7.8%. So how does the 7.8% growth rate, how does that lead to their assets and how they'll fare over the long run? So as you can see, they still have $2 million when they're passing away in this hypothetical life expectancy of an average age of 95. So that's great. They have more than enough risk in their portfolio to get their assets to last long enough, such that they don't run out of money during their lifetime. But what is the lowest return that we could earn in order for their money to be approaching zero towards that longer than average life expectancy? So let's play around with some numbers. So if we have a 4% return, as you can see, the money runs out far too early. It runs out at the average age 84. So that wouldn't be adequate for their needs for growth. Let's bring that up a little bit to 5%. We're still not quite there. I'm going to go up to 7%. That gets them to right around where they need to be. Their money is approaching zero by the average age of 95. So what does that translate to in terms of a minimum allocation to growth-oriented investments? It results in an allocation target of around 70% in stocks and 30% in bonds, which when compared to their current allocation, is slightly less than what they currently have. And so what that tells us is that they can afford to accept less risk based on what they need to grow their money by. All right, so I know that was a lot, so just hang in there and bear with me. The next two steps are a little bit less involved and complicated, but so we've determined that their need for accepting risk aligns with a mix of investments that resembles that of a diversified portfolio consisting of roughly 70% in stocks and 30% in bonds and cash. And so we'll come back to this, but the next step is to think about their upcoming liquidity needs. And so what we want to do is ensure that they can pay for their expenses over the near term without having to sell depreciated stocks, during a turbulent market. So let's take a look at what they're projected to need from their portfolio over the next 7 years, which would be towards the bad end of the range in terms of the break-even time from the beginning of a recession or of a deep downturn in stocks. All right, so we've already gone through this, but this is their cash flow. This is what they'll need from their portfolio. These are their liquidity needs, and so we said that 7 years is kind of the time frame that we want to be prepared for and ensuring that they have enough liquidity. So in the first 3 years, they don't need any liquidity. They don't have any cash needs. They're both still working. Their cash flow is positive. In the ensuing 4 years, when they stop working, they'll need roughly $319,000 in total to ensure that they have enough money to pay for their bills over the near term. All right, so our final step for completing our assessment of this couple's financial capacity for risk is to try and gain an understanding of their tolerance for risk and their comfort with volatility. And so this is the human side of the equation, and it can often be challenging to measure because humans tend to act irrationally during periods of fear and financial anxiety and market volatility, and our behavior will also evolve as our situations evolve. So for example, if an investor is 2 years away from retirement, they're probably going to view risk differently than they would if they were 20 years from retirement. So it's also an important consideration when you're trying to gain an understanding of how someone might feel or act during a period of market volatility. So it's an imperfect process and it needs to be monitored over time. But here's how I approach this with my clients. So, I believe that the best indicator for how a client may feel or act during a period of stress or anxiety is to gain an understanding of how they have felt and acted in the past, during real world examples of market volatility and economic weakness. So, for example, how did they feel during the financial crisis of 2008, 2009? Do they remember it being scarier than the dot-com bubble at the turn of the millennium when stocks were halved, and if you had tech stocks, you lost 80%? Did they find it scarier during 08, 09 than they did in the dot-com bubble? Then you can start to look at more recent, scenarios. March of 2020 stocks, after COVID started to become a real issue. Stocks were down around a little over 30%, and then in 2022 for that calendar year, stocks were down about 20%. So how did they feel during these periods? Did they act? Did they make any changes? Did they capitulate? Especially considering that they're much closer to retirement during these bouts of volatility. And so once I can sort of start to put these pieces together, I can take a look at their current allocation and I can discuss their current risk in terms of past scenarios that they've experienced, and then they can relate to those feelings and actions that they took and say, okay, how can I maximize the likelihood that I won't act and that I won't feel anxious if we did experience this type of volatility with the money that we have today. All right, so let's take a look at how their current allocation would have fared during these past historical examples of market meltdowns. All right, so based on this couple's current allocation of 85-15 stock to bond, historically, based on that allocation, the amount of money that they have today during the dot-com bubble, their portfolio would have dropped by roughly a $500,000 to around $1 million. In the financial crisis, they would have lost around $700,000 at the low point of 2009 in March. Their portfolio would have dropped from 1.5 million to 795,000. During COVID, they would have went down by around 400,000 to a $1.1 million portfolio, and then in 2022, they would have gone down by 250,000 to a $1.24 million portfolio. So we're not going to go any further until we do it all as when we tie this all together. But so let's look at these three variables: this couple's need for risk and their capacity for risk, and we'll look at all this together and see how we would use it to guide this client in determining the appropriate allocation for them. So to summarize, we're hoping to develop the target allocation between stocks and bonds that best aligns with this couple's need for growth without violating their needs for liquidity or accepting a level of risk that may increase their odds of making a hasty move during a period of market volatility. So their current allocation is roughly 85% growth, 15% preservation and income or stocks to bonds. And we've determined that their goals require an allocation of at least 70% in stocks. Since their current allocation is greater than what they need, they've satisfied their growth needs. So it doesn't violate their needs for growth. They have more than enough growth to meet their long-term goals. We've also determined that they need roughly $350,000 over the next 7 years for spending in retirement. Based on that need, as you can see, they have around $220,000 in bonds, with some of that being in longer-term, more volatile bonds. And so that would indicate, or that would tell us, that their current allocation does not align with their liquidity needs, and therefore they're accepting slightly too much risk based on their situation. So, and finally, let's assume that this couple doesn't remember their experience in 2000 because it was 24 years ago, and then during the financial crisis they were a bit they were a bit concerned, but they didn't sell anything. They also sold during COVID, but they got back on the train as things things improved and the situation started to look better. So what does this tell us? It tells us that they've grown more conservative the closer that they've gotten to retirement, which is to be expected. They unfortunately acted emotionally and irrationally during COVID by selling their stock. And what that tells me is that they may be more likely to do that again if there was volatility, especially if they're living off their portfolio. So that does raise some concerns that their current allocation may be a bit high, especially because it's higher than what they need to grow their money by. So how would I suggest this couple adjust their allocation based on the findings that we've just gone over? So since they're invested just a bit too aggressively based on their financial capacity for risk, I'd probably look to cut their risk, and luckily they can afford to from a growth standpoint. So what I'd probably look to do in this case is bring them down and dial back their stock exposure to 70% in stocks, 30% in bonds for a target allocation, with a net of a 15% reduction in stocks. All right, so 70-30 is the target. They're a bit high in stock. They're 85-15 stock to bond. Let's take a look at their existing portfolio on a more specific level, or a more granular level, and take a look at the actual investments that they have. And these are generic investments. There are no symbols or tickers or anything like that. So the first things that stick out to me are that they have a lot of their money invested in growth stocks specifically. And this is, I think, this is very common today because growth companies have done so well. And a growth company is just a vernacular for a company that maybe trades at a higher valuation, that's growing their earnings faster. They may offer higher returns, but they're also more volatile in a down market. But so a lot of people today, they've had a lot of money in growth stocks because they've done so well and they've grown so much faster than value and other types of stocks over the last decade and a half. So the result of that is that a lot of investors have probably an overweight or close to an overweight position in growth stocks in their portfolio. And so for this couple, since they're within 2 years of retirement, they have, between the growth stock fund they have in their joint account and the growth stock fund they have in the IRA, they're a little over 40% in growth stocks. And so I would view that as being sort of a red flag for somebody that needs to start spending off their money over the next 3 years or so, because if we have a deeper than average downturn, if we have some volatility, those stocks are going to go down by more or chances are those stocks are going to go down by more than the other diversified portfolios that they have. And so that's the first thing that would stick out to me. Another thing that would stick out to me is the high position in the low volatility funds. And I'm not knocking low volatility funds, but I think that it's a kind of a big bet on low volatility funds when unless they had a very strong feeling about low volatility funds and they really deeply understood why it was in the portfolio, that would probably stick out to me as being a bit high, and and it could be some more diversification in here. Another thing that sticks out to me is the very low investment allocation to foreign stocks. And so while foreign stocks have underperformed U.S. stocks for the last decade and a half to 2 decades, that doesn't necessarily mean that you should be incredibly underweight or you should have all your money in U.S. stocks. It is not I don't see there being a huge issue with somebody living in the U.S. having a bias to U.S. stocks and being overweight U.S. stocks. But when you're thinking about how much money you have in U.S. stocks versus foreign stocks, if you look at the global stock market, it's roughly 2/3 U.S. stocks, 1/3 foreign stocks. So if you're materially lower than that, right? Say if you have 5% of your money in foreign stocks, then you're hugely underweight foreign stocks. And there can be you can go decades where certain areas of the market, geographically can outperform or underperform. So having that lack of diversification on a global scale can be a risk, especially for somebody that's looking over a 10, 20, 30-year horizon. All right, so let's take a look at how I might approach this for this hypothetical couple, given their situation and everything that we've covered up until this point. So, right off the bat, we know that we want to decrease their stock exposure by around 15% from 85 to 70% in stock. And I already mentioned that I found it a bit troubling that they had so much money in growth stocks, and then also they had a pretty concentrated position to low volatility funds, as well as a massive underweight to foreign stocks. So this is kind of how I would think about it. So the first thing I would say is that the IRAs, the retirement accounts that are tax deferred, are the better place to make big changes for especially for stock investments, because you don't have as much of that capital gain dilemma where you have to pay taxes when you sell and book the profit. So the first thing that I would potentially suggest to this couple is in the IRA, where they have that $200,000 position of the growth fund. Since they're at over 30% over 40% in growth funds, I would have them sell that entire fund, and then to reinvest the proceeds for that, I would add 30 grand or so to a small cap index fund that brings their overall allocation at least a little bit in there, so it's a little more diversified across the size of the companies within the United States. And then likewise, I would add $70,000 to mid cap funds, which are generally speaking, considered to be slightly less volatile than small caps, but at the same time offer potentially some more growth potential than large caps, so somewhere in the middle. And then finally, for the proceeds, I would invest the rest in just foreign stocks, non-U.S. stocks, to add that diversification. And we'll go over how this results or how this changes their ending allocation, considering all their assets. So in addition to that, in the IRAs, I would sell the low volatility fund and spouse two's IRA, and with the proceeds, I would add 25 to a mid cap fund and 75,000 to a non-U.S. foreign stock fund. And then with the taxable accounts, as I mentioned, it's a little bit less easy to make a change with a stock that's been appreciated over time, because you have that tax element to it where you have to pay the taxes up front when you sell them. So although that is the case, I would encourage this couple to still consider selling off some of these concentrated stock fund positions within the growth fund and the low volatility fund, and a lot of this is going to depend on just how much appreciation there is and how much income they have in that year. So other things being equal, have them sell roughly $125,000 from the growth stock fund and then around $100,000 from the low volatility fund. With the proceeds, what I would do is I would redeploy that money. I would boost up their cash position a little bit. They only have $30,000 in cash outside of retirement accounts, so I'd put that in a money market or something that was relatively liquid, just to increase their liquidity, which could be valuable, especially considering their time horizon. And then in addition to that, I would add the rest into guaranteed short-term bonds. maybe build a 1 through 5 year, certificate of deposit ladder, treasury ladder, just to give them that cushion again to meet their liquidity needs over the next 7 years. So, I mean, if they retire in 3 years and then all of a sudden we're in a recession, they're set for a good period of time. And those short-term bonds and the money market are really going to be what gets them through that period until their stocks have enough time to make it back. So let's take a look at how this kind of translates to their overall portfolio. So overall, they have, the resulting portfolio would be around 53% in US stock, 18% in non-US stock. They have around 14% in short-term bonds, 7% in longer-term bonds, and 9% in cash. You might think, maybe is that a little bit too short-term for their portfolio? This is going to be subjective depending on the person, but since they told me earlier that they sold during COVID, I think that it would make them feel a little bit better about having that extra cushion. And, I think that it would give them some peace of mind knowing that if there is a downturn, they're good for a good long period of time. And it's highly unlikely at that point that they would have to sell the stock. And that might lead them to feel better and have less anxiety about their financial situation. The 7% long-term bonds, they're a little bit more volatile, but at the same time, they can offer that, extra return, potential, and they also have that element of safety, over the long run. So, thinking about this just from the stock side of things, so just looking at the 70% of their stock portfolio, this leaves them at around 75-25 US to non-US. I said this before, but the global stock market is around 2/3 US, 1/3 foreign, and the way that I think about this is I always start with that global benchmark. That's my starting point. If the investor is more comfortable with U.S. stocks and they feel pretty strongly that they'll outperform foreign stocks despite valuations and despite kind of where we are, then I'd be comfortable with them taking an overweight position in U.S. stocks. I think that's relatively normal, and I think that's fine. The modern portfolio theory would suggest they have more in foreign stocks because the expected future return on foreign stocks is likely higher considering where valuations are. But with that being said, I don't think it's necessarily a huge deal if they have a 10% overweight to U.S. stocks and 10% underweight to foreign stocks. But so this is kind of how I'd think about it. And then as they proceed into retirement, they're going to have a lot of opportunities to continue unwinding those concentrated positions. They'll take advantage of 0% capital gains, and yeah, so that's kind of how I would think about this. And again, this is a generic example, so everyone's situation is different. We'd probably go a bit deeper than this if this was an actual client, but I think that I really wanted to just give you some sense for how I think about this when I'm meeting with pre-retirees, how I'm thinking about what their needs for growth, liquidity, and their risk tolerances, and how that all translates into an allocation and investment recommendation. So I hope that you got a lot from this video. And if you ever have any questions, please don't hesitate to reach out. And as always, I've left a link to a complimentary consultation in the description of this video. It'll bring you right to my calendar if you're interested in talking with me. I wish you the very best of luck, and I hope to hear from you soon.